Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I've had several subscribers to our YouTube channel requests to cover REIT, specifically Realty Income. So with this video, I'm going to take a look at this, probably the grandfather of all real estate investment trusts, Realty Income. They also call it the monthly income company. I'm going to start as I usually do. Let's look at just some basic fundamentals regarding this company. To start with, you don't value REITs typically on earnings. You value them on what is really their form of cash flow called funds from operations or adjusted funds from operations. So I'm going to take the price off the graph here and I'm going to plot just simply the company's funds from operations going back to the year 2000. And as you can see, they've had steady growth. Growth has averaged about 5% a year. Company currently pays a 4.8% dividend and trades at an 18 FFO. The orange line on this graph represents an FFO of 15. That'll become important later. Next, I'm going to draw AFFO, or adjusted funds from operations, which has some different accounting adjustments built in. But one thing I want to point out about AFFO is that it's only been available for most companies for about the last 8 or 10 years. So you don't get as much data when you look at AFFO, which is why I'm going to go ahead and stick to funds from operations. Now, next I'm going to add monthly closing stock prices to this graph because this is all about valuing the REIT based on FFO. So I'm going to put monthly closing stock prices. And you can see back in 2000, the company traded at about a multiple of 8 to FFO. Then it moved up to 12 by 2002. And then it consistently traded in a range hovering near this 15 AFFO, which is the orange line. I'll take the normal price to AFFO in a minute so you can see the orange line more clearly, but I want you to notice that the normal price to FFO over this long time frame is 15.4. So what I have is a reasonable valuation level, and you can see that when Realty Income was undervalued, it kind of moved back into alignment with that 15 PE. Then we came to the recession, had a negative year and a flat year of FFO growth, and then we saw, of course, like we saw with most stocks, a significant drop in price. The value of this REIT fell from a high of around 28 down to a low of about 17.5, and that's a 38.5% drop in value. However, I also want you to notice that the company recovered itself very quickly in about a year's time here. And then we've had periods since the Great Recession. Let's go ahead and shorten the graph to look at that. As we've come out of the Great Recession, starting in 2010, we've seen a normal priced FFO of about 18. Now, this is considered one of the highest quality REITs in the country, and so maybe some of you would justify an 18 price to FFO as a fair value. If that's the case and you're in that camp, then currently the stock is pretty much trading at fair value, just maybe very moderately above that. However, the 15 price to FFO should still not be ignored because even over this period, you can see where the stock had gone there several times. But I also want you to notice that when the price to FFO got very high like it did in July of 2016, we've seen a significant correction in the value of this REIT. And I'm going to not go to the very bottom here, of about 23%, but this to me is primarily overvaluation. We did have a negative FFO growth year thrown in here, which is obviously a catalyst. When you have a company, whether it's a regular corporation or a REIT like we have here that's this overvalued, as Realty Income was in July of 2016, you really are vulnerable to any bad news. This was not catastrophic news, probably related to interest rate rising, etc., but we did see a very strong correction in the stock. Anyway, the company has a great dividend record. If I look at the track record over this time frame, which is a good time to measure it from the point of view, the fair time to measure because valuation was low back here. A $10,000 investment in Realty Income on December 31st, 2008 would have grown to $23,823 through yesterday's close, and it would have paid $8,291 in dividends. That's significantly more than the S&P paid. However, capital appreciation was slightly less than the S&P, but nevertheless, we end up with about a dead heat. The primary point here is this is more of an income stock than it is a capital gain. Now, if I go longer term here and look at the performance longer term, this was a perfect time to be buying this REIT when the price to FFO was down to 8. So had you put that $10,000 into Realty Income on December 31st, 1999, it would be worth $53,000 today, and that's more than twice what the S&P was, and it would have paid almost 9 or 10 times more in total cumulative dividend income, tripling the annualized rate of return almost, at least relative to the S&P. But there's two things I want to talk about here. This was a function of significant significant undervaluation, as well as the fact that it's moderately overvalued now based on this long-term historical norm. But again, based on the more recent history coming out of the recession at least, the market has valued the stock at about an 18 price to FFO. But I do want to go into something else, or I want to point something out about REITs that a lot of people don't take into consideration. If I go to adjusted operating earnings here, I want you to notice that the picture looks entirely different. Realty Income's operating earnings growth has only been about 2.5%. The market is valued at very high relative to that, but you can see there's almost no correlation between the company's operating earnings and the company's stock price, primarily because of a couple of the attributes of a REIT. Notice even the dividend payout ratio of earnings, that's the white line here, is extremely high, well over 200% in many years, almost 300% in some years. That's because REITs have trouble with operating profits. And let me point out one of the big issues with REITs that every investor that buys a REIT, in my opinion, should be aware of. And I'm going to do that by going into fund graphs or financial underlying numbers. And then I'm going to go into the millions graph. And what I want you to see here is what I would call common shares outstanding or dilution. In 1997, Realty Income had 51 million shares. They've increased their share count, and keep in mind, they've diluted shareholders as a result to over 284 million by the end of last year. So this dilution is what makes it very difficult for these companies to generate any earnings. However, if you look at different aspects of the company, for example, revenues, if I put revenues on here, you can see that revenue growth has been substantial, and that's really more related to a REIT because ultimately they have to pay out 90% of their money available for distributions, and that's probably, that's better measured as funds from operations. So let's go ahead and add that, and you can see that they're paying a significant portion of their revenues, but also paying out 90% of their money available net of revenues. But the real point here is that when you're looking at a REIT like this, if you look at it from a standpoint of adjusted operating earnings, you got to realize that a lot of this impact on this earnings here was the fact that the company was diluted so significantly over that time frame. Now, looking at forecasts going forward, let's go back to funds from operations and look at Realty Income from a standpoint of what its opportunity might be going forward here. Now, this graph is actually kind of important. This is a PE ratio versus interest rates. And as I mentioned, the normal PE ratio of this stock has increased over time. But here you see a normal inverse relationship as interest rates, and I'm using the 10-year Treasury as my proxy here, have gone from 6.5% to 7% in 2000, down to 2.87% currently, but they got all the way down to 1.5% by the end of November. We saw this, well, I'll call it trend of continuing higher multiples or price to FFO on REITs relative to the lower interest rates. So one of the risks that I think investors should consider, if rates do rise, that could have the opposite effect, and we could see multiples going back down to this 14 or 15 range, where I might even argue that they actually belong. Nevertheless, let's go ahead and look at forecasts here, and let's look at funds from operation forecasts. There are 17 analysts that believe Realty Income should earn $3.18 of funds from operations, or generate $3.18 of funds from operations by this year end. And then the same 17 analysts think it'll grow only about 3% the following year, and interest rates might be part of why the estimates are so low, followed by 2.5%. But again, this brings it to that 15 multiple that I talked about. If that were to be the case, the rate of return, including dividend income, could actually be negative over the next couple of years if this were true. However, I also want to point something else out. If I look at the analyst scorecard, how good of a record these analysts have had, you can see that the analysts have been forecasting FFO pretty accurately over this historical time frame. Now, the only point that really trying to make by pointing this out is that analysts have been reasonably accurate. So there's at least a probability based on that analysts could be accurate. But I then want to take a look at normal multiples. If I'm using the normal PE ratio that's existed for the last decade or so, it's somewhere around 17. To be conservative, I'm going to use 17 as my normal price to FFO. If that were the case, the rates of return on Realty Income would at least be positive. If you go to the more recent 5-year normal PE, it's 19.2, and that would be, it's very attractive. But the question is this company going to continue to trade? In this case, the time frame I've got up here is 2011 to current. at a 19 PE or an 18 PE as we see here. If that's the case, this is post-recession, then if I put that 17.9 PE ratio on this graph as a what-if scenario, then the returns going out for the next year or two could be very decent. Double-digit this coming year and averaging 8 or 9% going forward. But the point is, this particular real estate investment trust is extremely high quality, but it's not excessively cheap. Now, I had a comment in one of my recent videos where they talked about, buying on these graphs doesn't take into consideration what's going on in the market or what's going on in the stock. So I want to make something clear. I would never suggest buying or selling based solely on these graphs. The idea behind fast graphs is to research stocks deeper and faster. So we do provide links into several other quoting services where you can learn more, including a service like Seeking Alpha where you can, click on and read articles or news items or see their financial reports, etc. But more to the point, you can also go directly into Realty Income's website and, look for things like, first of all, I always like to, you can see acquisitions, backgrounds. You can go in and look for investor services and look for investor presentations. It's something I like to do when I'm researching a stock. And then once you do that, you can go in here and look at these presentations and then, see what the company's telling the analysts that are making those forecasts I showed you earlier. And, you can get some additional information and color on how the company might do. The point is, this is a really good research tool, and you can learn an awful lot about the companies that you're looking at, whether it's a REIT or a regular corporation, by looking at their historical performance over time. So anyway, I want to thank you all for listening. And if you have any questions or interest in learning more about fast graphs, simply dial the number on this slide or send us an email at www.fastgraphs.com. And you can also direct that to policy@fastgraphs.com if you want to speak directly to our associate who handles inquiries on the company. Anyway, this has been Chuck Carnevale saying thanks for listening.